Hey, everybody. Welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. This is your co-host, Tim Douglas. And today on the show, we have Sheridan Murphy, who is the owner of Murphy Financial Group. Sheridan, how you doing today?
I'm doing terrific, Tim. Thank you so much for taking some time to talk to me today.
Of course. No, thanks for coming on the show. And we'd like to jump right in. So if you could start with just telling us a little bit about your firm and then specifically about your journey as an advisor, that'd be great.
Yeah, I'd be more than happy to here, Tim. So my firm is Murphy Financial Group, of course. We're a couple of years into the business as far as having the name on the door, so to speak. We're a very typical financial planning firm. We are entirely fee-based, so we deal exclusively with the SEC. I do personally still some FINRA licensing, but moving forward, I doubt it'll be a cornerstone of a lot of our business. And as far as how I got into the business myself, it's a bit of a long-winded answer here, Tim. Hopefully you'll indulge me here a bit. So I graduated local school here in the Midwest, Miami University of Ohio, the less cool Miami, a lot of people know it as. Left their business school, went right into working at Fidelity, obviously a massive company most people know. They have a presence here in the Midwest and specifically in the tri-state of Indiana, Ohio, and Kentucky. They're in Covington, Kentucky. They have a campus with about 5,000 employees. Anyway, joined them in July of 2017. Did some back office work that wasn't overly stimulating, frankly, but was interesting, and the industry in general caught my attention. Shifted over to more of the client-facing side, got registered, sat for Series 7, Series 66, et cetera, helped people out with trades and so on and so forth over the phone. And I really loved the work. I always loved the work, but I found myself conflicted after a while doing that job. And mainly that was because I could sit there for 30 minutes, 45 minutes, an hour plus with somebody and really feel like I made an impact on their life and assisted them in a dramatic way with their finances. And that was it. The line would go cold from that point on. You really would never speak to the same person twice. And I hated that so much because the personal relationships is really what is my favorite part about this business. At the end of the day, of course, I'm a businessman. I want to drive business. I want to drive revenue and scale. But I also really enjoy helping people. And that missing piece was something that I really craved. And it drove me to go independent. And, several years later, here we are with Murphy Financial Group and a host of clients.
Interesting that you only talked to them once. Like there wasn't even an annual checkup or every 2 to 3 years you met up with them again.
Well, that's Fidelity, of course, having millions of customers, thousands and upon thousands of employees, is that in my particular role, I would speak to them typically on just, hey, I need this trade set done, or talk about this trade or that trade. And it wasn't exactly advising work. It was more transactional.
I see.
So there were certainly people at Fidelity that did that. And, I could have continued along that career path and perhaps had more of those kind of relationships, but it also wouldn't be my relationships. It'd be Fidelity's relationships and kind of that whole song and dance. So for my purposes at the time, it was really just transactional one-time conversations.
Yeah, no, that makes a lot more sense. And we've had a lot of people, not who are quite in your role, but who have come on the show, talked about being with the bigger houses. And where it's like, yeah, it's just not very personal. You can't customize it to the client as well. And I'm really looking to build those relationships. So I really admire that you stepped out and went the independent route. And obviously there's some risk there. It's not as safe as working at a Fidelity, especially when you're getting your own business started, but you did it. And you did it for the sake of relationships and clients. And I think that's some of the most important stuff in the business. And so given that you are now strengthening those relationships with clients, working with them day in and day out, how are you staying up to date with the latest market trends and financial strategies so that in conversation with those clients, you can give them the best information so that you guys can come to the best decision for their portfolio together?
I suppose in that regard, it's a little bit of this, a little bit of that, kind of a jack of all trades. So certainly consuming traditional media, which would be, if I'm at the gym in the morning, turning on MSNBC or something that'll catch my attention in that regard, making sure I'm staying current with traditional markets, all the talking heads, but also more modern methods, which would be, I have maybe 25 different market watch notifications that pop up on a daily basis. Staying in the trenches on a daily basis in terms of different sites, um, getting other sources of information. Like I said, kind of a jack of all trades, but also in very proactive methods, which would be not only interacting with clients, but also peers in the industry, perhaps people that are tangential to the industry. Just always staying active, trying to constantly be pounding the pavement, talking to people, and making sure I'm always got my finger on the pulse of everything. So a little bit of this, a little bit of that.
Yeah, so it sounds like you got the traditional methods, news, those kind of big financial news companies, financial sources that are updating you regularly. You probably follow some big financial names that are constantly doing market commentary, but it's also like pounding the pavement, like you said, nose to the grindstone, and really making sure you're connected well in the industry so that you have access to up to date news, various perspectives, and niche strategies as well. Is that about right?
That's correct, because at the end of the day, we're providing specific financial planning services, particular in this case to people's investment portfolios. So even if we see something that's on mainstream media, it doesn't necessarily mean we're going to flip everything on its head, right? A lot of this stuff you can see coming. We're running different projections and we're staying current. But at the end of the day, just because we see something doesn't mean we're going to make massive changes. If that makes sense. I know maybe that wasn't the best answer.
No, that makes perfect sense. I don't know what another answer would be. Like you're staying up to date with stuff, but you're also being proactive and it's very individualized. So not only can you see this stuff coming, but you're working with clients day to day on their personal goals. And somebody who has a 30-year timeline for their investments is going to be a little different than somebody who needs income next quarter for their livelihood.
Yes,
And so constructing the portfolio accordingly only makes sense. And making sure that, the big swings in the market don't affect that person who needs income now and that the person who doesn't need income now isn't worried about them. It's like two different scenarios, right?
definitely, definitely.
For sure. Well, we talked about kind of staying up to date with the latest market trends and financial strategies and how that is unique to the client. I do want to jump to current market insights now. In your staying up to date, what do you think are the key factors to pay attention to in today's market? And then what's your high level strategy to address them? Because I know, on an individualized level, stuff changes, but the high level strategy.
Definitely. So, the past couple of years, it's really been all about inflation, interest rates, volatility. Those have all been kind of the hot pieces of talk the past couple of years, and it's certainly something that is driving a lot of what we do. And as you just alluded to there, Tim, this is going to be very situational depending on who we're talking about, what their timeline looks like, risk tolerance, etc. So for our purposes, primarily, and again, this is something that's going to be more high level strategy, perhaps something that's much more typical to who I'm working with, which is, I have a good mix. I certainly have some pre-retirees, retirees, people that are in advanced age, 70s, 80s, and those needs are different. But primarily, I'm working with people that have a bit of horizon, a decade, 2 decades, perhaps three, before they're looking to draw on this. So in these kinds of situations and environments where we're seeing, again, high inflation, high interest rates, a lot of volatility, going back even to COVID, we're trying to really lean on what we know to be tried and true. So myself personally, there are certain experiences and different pieces of literature and other things that have shaped me as a professional. One of those would be a book called Stocks for the Long Run. It's without going down the rabbit hole, it really just harps on the fact that equities tend to be very strong response to changes such as that in the market. It tracks inflation well. It keeps up with interest rates. et cetera. And that doesn't mean that all equities are made the same, of course, but one that I tend to lean on quite a bit is just high quality equities that have a long tenure of raising their dividend and having a strong dividend, 2, 3, 4% typically. And they tend to not have the high highs and the low lows that you see in these volatile climates. They tend to weather the storm much better, and they have, again, a strong track record of doing so with historical data. So we have a much better sense of how things will look in times like these, and really just in general. So I tend to fall back on methods that are tried and true, such as that, as opposed to something which would be much more recent and modern. So the past couple of years, again, many tech stocks, the Teslas of the world, the Nvidias of the world, have really been high flyers, and certainly there are gains to be had there. But I struggle to really create a meaningful plan for somebody's retirement and their legacy around something like that, where, again, very volatile, might go up or down several 20, 30 points in any given year. And it's tough for me to build a meaningful plan around that. So again, it's something that's much more tried and true, as opposed to what's the hot topic of today.
So I feel like a lot of people would hear that and then they would have fear of missing out because there is return to be had there. So how do you deal with that emotion when it comes to clients or potential clients when they hear that investment philosophy?
It's really just, well, first of all, I think there's work to be done on the front end of that. And that's something I take very personally. Is, again, I got into this for the client relationships. I want to make sure I'm being transparent and always on the same page with them, in many ways educating them so they have a very full understanding of, why are we doing this? How is this in your best interest? What will this look like for the short, intermediate, long term? So with that being the case, of course, within the past week or so, we've had the kind of the meme stock craze come back real quick and exit stage left again. And people have questions about that, of course, where it's, oh, there's gains to be had here. Why are we not, capitalizing, et cetera? And there's certainly always going to be a piece of our allocations for, of course, somebody who has a proper risk tolerance for it, that'll have, things like Tesla in there, Nvidia, other prevalent technology stocks we've seen over the past couple of years, because we do want to chase some of that growth, but we're never going to do so in a reckless fashion. And we want to make sure we're properly allocated. So within the past handful of months, we've started to see some historical high points for several indices, as well as positions like, an Nvidia primarily. So we will have exposure there, but make sure we're constantly rebalancing, making sure we're keeping up on that. So we are never putting them in a compromised position. So we do have a hand in that growth, but never to a point where it's going to really make or break us.
I gotcha. That makes a lot of sense. And it sounds like with your portfolio construction, my initial question had given today's market, what do you think are the key factors to pay attention to? But it sounds like you're constructing portfolios with the, tried and true companies that have good fundamentals, strong dividend growth. And then you can deal with FOMO by also constructing portfolios where it's like, hey, the majority is in that tried and true stuff, but then you may have a portion to kind of chase that growth. So you entertain that, but it's not the end all be all. It sounds like with that philosophy, you don't have to worry about the kind of ups and downs and volatility of the day-to-day market. Is that accurate or inaccurate?
I would say that's more accurate. And of course, this is also
no guarantees.
Right, of course not. But this is also individualistic, right? Where a client might approach me and say, my risk tolerance. I have plenty of time to swallow this loss if there happened to be one, but I want to get more into the game. I want to get more aggressive with these, maybe it's very tech-based companies, and we're just looking for pure return. What can we do based on what you see maybe this year in the next 18 months to really try to track those returns? We can absolutely do that. Of course, again, it's individualistic, but on the aggregate, typically we're able to go through periods like we've had in the past couple of years, because yes, like you said, we're doing many things that are tried and true. The backbones of our portfolios are tested for decades. We're tracking, again, high quality, high and very predictable dividend returns, so on and so forth. So again, we can augment that with whatever the client is looking for based on, all of the know your customer items. But yes, primarily what you said is correct. We're doing so in a manner that is very, very classic, and doing so in a way that's proven to be accurate in the past.
So we talked a lot about some of the key factors in today's market and how your portfolio construction really handles that insofar as you don't need to worry about the ups and downs of the market all the time. Of course, it's an individual case by case basis. Our next question is typically about risk. Do you feel like what we've discussed so far has covered your perspective on risk, or would you like to add something to your strategies for risk management?
I would certainly like to supplement that with a number of things here, Tim. So, in terms of risk management, there are obviously some very traditional methods of doing so. You think allocation, typically we're talking equities and fixed income. Some people would just prefer, hey, let's boost the fixed income portion of that. It's going to typically have less volatility. It's going to be able to weather the storm and manage more risk. And certainly that's doable. In the past couple years, 18 months, that has not always been perhaps the simplest method. Of course, we're talking about an environment where we had a number of rate hikes. Inflation has been high. That can cause volatility, of course, in the price of bonds, whether we're talking about treasuries or corporate bonds here. So, although that's still an option, it's one that has also been more difficult to navigate, just given the particular climate we found ourselves in. So, there are other items I like to be able to offer, or tools in my tool belt, so to speak, such as annuity products, insurance products. Whether we're talking about more modern type offerings, which would be on the annuity side, at least like buffered annuities, where you can kind of still be similar to an equity return, but you have a floor as far as how much you could lose. That's risk management, of course, built into it. Fixed annuities, where you're talking more on the guaranteed side, or variables, which again would be similar to the variable side, or the buffered side, and not trying to entirely get out of the exposure, but trying to dial it back a bit. But also, and I think one of the more advantageous results of the past handful of years, and now we're talking 5, 10, 15, 20 years in some cases, where we've started to see more almost creative options, or of course less traditional options, like AI opportunities, speaking of course of alternative investments, which can be a very flexible and solid offering for people, where they want to have risk managed, but they don't want to do so in a manner where typically you're talking about a bond that's not going to be paying a very high coupon. And a lot of these alternative investments are have possibilities to be bringing back a higher yield for a certain amount of years. And I know you would be a better expert on that than I would be, Tim, given your guys' product line there at Stallion. But that has also been a terrific asset class to introduce to somebody who would be looking to manage risk, but maybe also doesn't want to entirely give up the prospect of a return.
Yeah, no, absolutely. It's so important to have a variety of products at your disposal. Equities are great, but when you talk about these insurance products and you talk about these alternatives, it can be a big deal when it comes to building a client portfolio, especially on the risk mitigation side of things. A lot of people thought bonds could never do what they did in the past couple years. And when that happened, a lot of people came over to Stallion. We had a good couple of fundraising years because we have that stable, consistent, steady product backed by some of the best real estate in the country. And so people are always looking to mitigate that risk. And I think you coined it well with how you address it. It's like, I'm going to have many products to meet my many client needs at any given time.
I couldn't agree more. And that's, typically speaking, when we're talking about, hey, I have somebody that comes over, wants to manage risk, but hey, do you want us to look at a portfolio that would be typical to traditional fixed income, different kinds of bonds? Of course, we already touched on this. Or are you open to something that's still extremely stable, like the real estate market has typically been? And obviously, it's depending on where exactly you're attacking the real estate market, or looking to find opportunities there. But as you said, it with at least with Stallion, they have a terrific portfolio of some of the strongest real estate in our nation, and it allows for somebody to very efficiently manage the risk, but also still get very a very solid return and a good yield, and it can just really fit a niche that they're looking for in their portfolio, especially when we've seen more or less unprecedented market situations as we have these past couple years.
For sure, for sure. And I do want to jump over to alts now. When you're really looking at alts for a client portfolio, how are you evaluating them in today's market?
Well, of course, it's going to come down to the strength of the company, right? That portion of it, I would just compare to traditional fixed income, where it's, hey, that's great if we can look to get the kind of coupon they're offering, but if it's a junk bond, what's the point? We're just spinning our wheels here. So certainly, you want to make sure that the company that's bringing it to market is worth their salt. So traditional kind of research, I think, is never going to go away. That's something we want to do, and that's going to be much more on the typical sides, looking at anything that we can find from financial information on the company, et cetera. But getting further into it, in particular for this alts, in terms of real estate based alts, it's going to be, what else are they doing here? What kind of real estate are we talking about? Again, talking about just the past couple of years, and unfortunately bringing up COVID. I mean, what COVID had shown us for a number of years was these massive corporate structures that you have in any given metropolis, these sky rises where thousands of people would gather for 40 hours a week to do their job, weren't as necessary as they had been in the past. A lot of remote work, people can kind of work anywhere, work from home these days, showed that part of real estate just was going through a transition, and probably was not the most popular place to be putting money over the past handful of years, as a lot of those have been purchased, those towers that is, purchased at a severe discount to what they had previously changed hands for, and just or perhaps even turning into residential space, et cetera, et cetera. So again, it's going to come down to hitting a lot of different research boxes and just making sure that everything looks sound, not only from a company perspective, but from an offering perspective, and what the outlook looks like during the course of that product.
Yeah, no, absolutely. I think that's such an important point there with what the office real estate market has done, and some of those assets. If you went in at the wrong time, you probably felt it, because if you went in right before COVID and office got decimated, that was really bad. So making sure you know about the opportunity. What's that quote? Just never invest in something that you don't know about, or always invest in something that you know about. I think Warren Buffett just talks about this kind of competitive edge you can get with knowledge in the market. And I think the more you know about a real estate opportunity, the more you know about a market, the better you can judge a manager, judge a company, and judge the specific opportunity. And so I like that you brought up those 2 points, both the strength of the firm, the strength of the manager, but also the strength of the opportunity. And so kind of keeping those two things in mind, they've passed due diligence now. They've passed that kind of strength of an opportunity and strength of a firm. What role are you really seeking for alternatives to play in a client portfolio?
I would personally, again, going back to just my roots and how I have just seeing through my perspective as a professional in this space, I'm somebody that much more prefers just quality equities that have a strong track record of high returns specific to dividends and just good management for decades. Something that we can look back on historically and find the sort of information we can build a portfolio around, right? And also equities tend to have a better, they tend to handle shifts in our economy better. Again, they do better for inflation adjusted returns, something that a lot of historical fixed income doesn't do, specific bonds, of course. So what I like when it comes to alts in a modern portfolio is really a bond replacement, bond specific replacement, for all the reasons that we had talked about, where it's far more flexible. It can give us, in many cases, a better prospect at a higher return, and all in doing so, again, in a very flexible fashion. So that's typically where I like to see an alt exposure in a typical portfolio.
So, jumping to the last section of the show now, I would love to hear about what you think is most important to that client advisor relationship. We talked earlier about the upfront work and the importance of relationship. So, what is most important to that individual relationship?
Definitely, Tim. So I'm going to piggyback on most of the sentiment I had previously in the show here. And, I think a lot of it is, to quote a bit of a mentor I had earlier in this career, was what we're tasked with doing is very simple in nature, right? It's we're trying to help people get to the finish line with their retirement goals. The concept of it is simple. Obviously, it's extremely complex, but we're trying to take a simple idea here and expand upon it with people. So the simplistic part of that I think a lot of people overlook is just communication and transparency with people at all times, right? I want to make sure we're always on the same page to get to the goal at the finish line here. So, in the fledgling part of my career here in the early years, you really learn, what kind of person am I? What kind of professional do I want to be? What am I good at? And I remember I had read a book a number of years ago. It was called From Good to Great, and it was really about just finding what you can be best at and really honing yourself and your practice and your career around that. And what I realized was, even for most advisors in this space, there's a point of pride of, I want to be ahead of the market. I want to get the best returns in the market. I want to be, Warren Buffett or one of these just prolific stock pickers, and investors. And I realized probably never going to be that guy, frankly, even if I can, do a solid job with building portfolios, et cetera. But I know for a fact what I can be the best at is just caring the most about the people that I work with and the people that I do business for. So I really have tried to structure my practice and my career around that is just constantly making sure I'm looking out for them in every way that I possibly can, doing what is always best for them, asking questions so that they can think about things in the future perhaps they had not otherwise, and we can start to plan for that. So I would say that is the most important thing: is communication, transparency, making sure we're always on the same page.
That's relationships right there, right? Just being honest and transparent, communicating well, and being willing to do the dirty work of getting on the same page, especially with some of those initial conversations. You're understanding them, they're understanding you, and y'all are trying to come to a mutual fit to make sure that you can get them to their portfolio goals. So I like that you have prioritized those two things, because it's the soft stuff that will often get overlooked, but that is most important.
I couldn't agree more, Tim. And it's that's the part of this job that it's always been an interesting dichotomy for me, where of course a lot of this job is it's hard figures, right? It's black and white, it's numbers, it's very typical mathematics. But what I find a lot of the joy in is not the quantitative part of it, like I just described, but the qualitative, where it's, you show up to somebody's retirement party and you help them get to that retirement goal, and they're just absolutely elated to get that next portion in life, knowing that they have a solid plan in place. And perhaps the less exciting part of that same qualitative token would be, showing up to a funeral and having to talk to the family and just be by their side during one of their toughest days, but also knowing we put things in place so that you all will be fine. You will be fine. Your kids will be fine. Everything is put in place. And there's just a very basic humanistic joy to helping people out. And that's really the part that I find more joy in this job. And again, getting back to the earlier parts of our conversation, that's really what drove me into this space, on top of the obvious, which would be, just being entrepreneurial, having a love for business, but also having a love for helping people.
Absolutely. I love it. Well, I feel like you already have a little bit, but tell us more about the brand of your firm if there's anything you want to add.
So I am the sole owner of Murphy Financial Group. We are obviously looking to expand via very traditional methods, whether that's acquisitions or perhaps growing organically, bringing more people into the fold. But furthermore, I am part of a larger endeavor here, which would be the RIA firm that I do business out of. It's called United Advisor Group. And it's not as traditionally set up as other firms throughout the past several decades, frankly, where you would have, maybe a partner, a couple partners, and it would be traditional hierarchy. We're very democratic in the sense that I have a dozen other partners that we collectively own the RIA for the mutual benefit of not only ourselves. Of course, we need the RIA to do business and be compliant with the regulatory bodies, but also we're able to do so and constantly make sure that we are negotiating prices, whether that's fee based or otherwise, so that our savings can trickle down to our clients, and we're always doing what's best for them. So it's certainly an interesting take on how we structure typical firms. So our RIA is what's called a single tier partnership. And it's just a kind of a different flavor on how firms have typically been set up.
There we go. Yeah, that's very unique. I've only heard of one other firm like that. And I'm sure they're very different. It was more just the kind of shared ownership amongst partners is what I heard about. But that's very interesting. Thank you for sharing that.
Definitely. And it's, of course, anytime you're doing something that's a little off the beaten path, there's going to be some, I don't know about growing pains, but just you don't know what you don't know type of deal. So when we certain situations occur to us, it's always going to be making sure we're doing things for the right reason, and making sure that we're constantly communicating with one another to overcome whatever obstacle may be in front of us. So yes, it's certainly a different take, but the structure of the RIA itself is not. It's we do not keep any profit. All of the revenue is given back to the partners, and then they give that out to other people in their firm. So the RIA itself is essentially just it's there for that mutually beneficial that purpose that we had talked about, which again is a little bit different. So the ownership on that, it is shared ownership, but also at the same time, it doesn't really have any intrinsic value. So there's really no reason to have the ownership, right? It's everybody that is a partner can run their business the way they see fit, obviously being within the boundaries of compliance. But otherwise, yes, there's no revenue that sits on the books. It's all distributed out to the partners based on how much of the revenue they're bringing in.
I see. I see. That makes a lot of sense. And so I'm curious, do you guys ever collaborate if clients have a question and maybe you need a specific type of expertise and there's a partner in the RIA that does it? Or is it really just kind of that pass through entity?
No, we definitely collaborate, because at the end of the day, if we're enriching each other's practices, it's going to allow us to do better. And there certainly does come with more numbers comes more benefits in many cases. And in this case, it would be, the larger we become from an assets under management perspective, we have more ability to negotiate with people like our custodians and other business partners, and we're able to get better rates, which again then can trickle down to our clients. So it is truly mutual beneficial in that way. So everybody kind of has their own specialization. So for example, if I do a number of things for medium to small businesses, a lot of my clients tend to be owners of medium to small businesses. And so if anybody has questions on, hey, small retirement plans, things of that nature, I tend to be able to help them. So if they have a one-off situation and need to pick my brain on that, or need me to step in and assist, I'm more than happy to do that. And likewise for the rest of the partners.
There we go. That's very cool. Sheridan, I think that is all we have for you on the show today. If people want to find out more about you, where should they go?
So of course I'm on all the different platforms here, LinkedIn. I am on places like Instagram, and I have a website. It would be investmfg.com. So MFG, Murphy Financial Group. I'm available there. And really across the board, Tim, I'm sure you can drop all my availability in the link to the podcast itself.
Absolutely. I was just about to say that all the links to contact Sheridan will be down in the show notes. Thank you guys for watching. And Sheridan, thanks for coming on the show.
Thanks for having me, Tim. It's a pleasure.
All right. And we will see everybody on the next one.